Welcome aboard the Bitcoin Express. My name is Chase. Let's get to it. In this video, we're going to go over a crypto tax trick that every crypto trader must know. And it's called tax loss harvesting. And it can save you a lot of money. With tax loss harvesting, with this method, you can use your crypto losses as a tax write-off, or you can use your crypto losses to offset having to pay any gains or any tax on other capital gains. And that can be something such as the stock market, selling a car, or selling a boat. And with this method, you won't have to pay the tax on those gains. And to truly understand the value of tax loss harvesting, we have to have a good understanding of how taxable events occur. So taxable events occur within the year, and that's January 1st to December 31st. And I'll repeat that again, January 1st to December 31st. So during that period, if you sell something for a gain, taxable event. If you sell something for a loss, taxable event. Now, if you buy something and you don't sell it, you just hold on to it, there are no taxable events. Nothing occurred. There was no gain, there was no loss. Now, if you buy something, let's say cryptocurrency or a stock, on January 5th of 2020, and then you sell it on January 1st of 2021, there is no taxable event for the year of 2020 because during that period, you did not sell anything. You sold it into the next year, January 1st, 2021, and that's where you'll pay the tax in 2021. So when it comes to cryptocurrency or stocks, we all know if you sell it for cash, you have to pay a tax. This is pretty obvious. I think we all know that. But what many people in the crypto space don't know, especially newcomers, is that when you sell a cryptocurrency or trade it for another cryptocurrency, this is also a taxable event. So using a very simple example, if you have $10 worth of cryptocurrency, it gains value to $20. Now you take those $20, you sell it, you trade it for another cryptocurrency, you now have a taxable event of a $10 gain. So whether your bracket is 10%, 20%, or 30%, you owe $1, $2, or $3 from that $10 gain. But many crypto traders don't know that crypto to crypto is a taxable event. So what they do is they'll trade it for another cryptocurrency and then they'll hold it into the next year without realizing that they still owe tax on the previous year. And this could become a big mess, a big problem. And there's a very famous Reddit post of a man that was trading crypto all the way up to $880,000 portfolio. And then in 2018, there was a huge crash in the market. He lost almost all his money, and now he didn't have the money to cover the tax that he owed for the year of 2017. So it's very important to note this with crypto, that crypto to crypto is a taxable event, and that also the year is from January 1st to December 31st. So now that we know this, we can use the power of tax loss harvesting to our advantage. So the way this works is, let's say we're going to use an example of someone that has $10,000 worth of cryptocurrency. And throughout the year, it's losing value. Maybe now it's worth $7,000. So they have a loss of $3,000. So if they sell their cryptocurrency before December 31st, now they have a tax write-off of $3,000. So with tax loss harvesting, it can be done any date before December 31st, but it actually can even be done on December 31st, even at 11 p.m. on December 31st. So using our example of $10,000, there's going to be two situations that it can go, that a person can have. One, they can just have their $10,000 turn into $7,000 and just hold it into the next year, or they can have their $10,000 turn into $7,000. They can sell it on December 31st for, right at 11 p.m., 11:30 p.m., create a tax loss, and then they could just buy it back a few hours later on January 1st of the next year. So in both of these situations, the person still has, $7,000 in one year and $7,000 in the next year. But in the second situation with tax loss harvesting, the person still has the same amount, $7,000, but they just created the illusion of a tax write-off that they can use and apply to their taxes for that year. So typically this is illegal. With stocks, this is not allowed. This would be considered a wash sale. A wash sale is when you sell your stock at a loss so you can make a tax write-off, and then you buy it back immediately with about the same amount or a very similar amount. So you can do this in stocks if you sell it and then buy it back after 30 days. So if you sell a stock and then you buy back the same amount a couple days later, within 30 days, it's not allowed, it's illegal. But again, you are allowed to just sell your stock to make it a tax write-off. And again, you are allowed to sell your stock and then buy it back 30 days later. It's just about how quickly you buy it back. But luckily, this does not apply to cryptocurrency. And this information is coming right from cryptotrader.tax, who takes the information directly from the IRS. And the IRS specifically states that wash sale or wash rules only apply to securities, and cryptocurrency is considered a property. It's not considered a security defined by the IRS. So at the time of making this video in May of 2020, wash sales do not apply to cryptocurrency. So you can literally sell your cryptocurrency on December 31st at 11:50 p.m. and then you can buy it back at 12:30 a.m. on January 1st of the next year. And you have the same amount of cryptocurrency, but you just created a taxable event, a taxable loss. So we use the example of $3,000, but this number could be different for people. It could be 5,000, 10,000, 100,000, who knows? But how does it apply? So it applies in two places and in an order. So when you have tax write-offs or tax losses, the first place it applies is to offset any other gains you made, any other capital gains. So let's say in our case, you're down $3,000 tax write-off, but you made $3,000 in the stock market, or maybe you made $3,000 selling your car or selling a boat. Typically, you would have to pay a tax on that gain. But because we're using the tax write-off from our crypto, we now do not have to pay any taxes on our gains from these other capital gains from these other assets. But what if you don't have any other capital gains? Or what if you have other assets you own, but they also lost value? Then how does this tax write-off apply? Well, then it will apply to your income. So the maximum amount that can be deducted from your yearly income is $3,000. So let's say you make $50,000 a year and you have this tax loss on crypto of $3,000. Instead of having to pay tax on $50,000, you now only have to pay tax on $47,000. So you're saving money still. And let's say for this purpose, you have $10,000, right? And maybe $2,000 of your loss. Okay, bring it back a second. Let's say you lost $10,000 in crypto of tax write-offs. So you might take $2,000 and use that to offset some capital gains from real estate. Then you have this money left over. Now with the leftover money, you'll take $3,000 of that and apply it to your income. So still you'll have a couple $1,000s left over. What happens with this leftover money from this tax loss? It just carries over until the next year. And it'll go in the same order. So if there's still money left over in the next year, it will first apply to capital gains, and then it will apply to your income. And it'll keep going, carrying over until the money runs out. So if someone has $100,000 in capital losses, whether it's from crypto or something else, it'll keep carrying over until the next year. So hopefully by the end of this video, you have a good understanding of how this all works. And if you have any questions, I definitely would recommend going to cryptotrader.tax. They have great customer support. They'll answer all your questions. I am not affiliated with them. I have no affiliate links. They do not sponsor me. It's just a service that I really recommend, and I've used them in the past. So with all this knowledge, hopefully this will help you take advantage with tax loss harvesting. I hope that you found value in this video. Subscribe to the channel, like the video. Thank you for listening, and I'll see you next time.